All right, so here I am again with the AOSL chart. As I mentioned last time, this is just a good chart to easily kind of see the principles of what I'm talking about because it played out in a very smooth fashion. Sometimes it won't be quite so clean. Sometimes it's even more clean, but this one just does a good job at showing kind of what I'm trying to illustrate here. Last time I had briefly mentioned when I was going over the same chart about risk versus reward and taking some profit at certain risk multiples. So I wanted to do something to quick elaborate on that point and kind of give a visual to those risk multiples and what I'm referring to in that regard. So based on what I was talking, like the entries and such I was talking about last time, if we look at here, and our risk is 68 cents technically, each of these is the same amount of cents as that risk. So each of these boxes covers the same amount of price as our risk, meaning each one of these is a multiple of our risk, you know? So if you were to say get a 1-to-1 risk reward, it'd be buying here, selling at the top of this step right here, which would be 1-to-1. If you were to get 2-to-1, selling right here, 3-to-1, 4-to-1, 5, 6, so on. So I think this gives a good visual representation. And basically, if it were me, what I like to do is sell a chunk at like 3-to-1, somewhere between 3-to-1 and 5-to-1, depending on the volume and how fast the move is to get there. So selling at about 3-to-1, and then maybe that's only 10% of my position. Maybe it's 20%. Once again, it all depends on kind of the ATR, how fast of a move it is, the broader market. So there's a number of factors here, but I'm going to be selling some, you know, even if it's as little as 10%. Generally, it wouldn't be less than 10%. Like let's say I have 100 shares of something to make the math easy. There's not much point in selling just 5. Personally, I don't think. So it would be at least like 10%, but do whatever you want, you know, manage the position however you want. This is just to try to help visualize. So if you were to hold the whole position through all this, you'd get a 12-to-1 risk reward. And hell, if you were diamond hands enough to hold it up here, it'd be like 15-ish to 1 or something, right? So it'd be like 13, 14, 15, 16. Yeah, you could get like 16-ish, 15, 16. So yeah, that's kind of what I was referencing last time, in that you want to be selling some to strength at these risk multiples. And personally, I end up selling too early a lot of times. So little warning here, I'm about to switch to something that's a white background. So maybe turn your brightness down or something. I just want to show kind of this, how this works out, laid out like mathematically as a probability game. So if you're using this as a probability game, you can kind of picture, this is something I read from Mark Minervini, who I mentioned last time, is if you picture, and this is a similar analogy, not the exact thing, but if you picture trading as like a coin flip, right? So in a coin flip, your accuracy is 50%, you know, 50-50, because could be heads, could be tails. But what if somebody told you, I will give you $3 every time it lands on heads, and you have to give me $1 every time it lands on tails? You would want to flip the coin as much as you could, right? Obviously, because if you flip the coin 20 times and it truly is, obviously you could have a string where, you know, if something crazy happens and you get a ton of tails in a row or a ton of heads in a row or whatever. But statistically speaking, the probability is that it's going to be about 50-50. So for the math, let's call it 50-50. And you flip a coin 10 times and you lose $5, but you gain $15, you net $10. Simple as that. And that's what this style of trading comes down to. Now, the accuracy is based on your ability to scout setups with a higher probability of working. Now, higher doesn't mean higher than 50-50. I just mean the higher the probability of a certain setup working, you're putting the odds in your favor. That goes without saying, really. But this is just kind of how it breaks down mathematically. If you only have a 30% accuracy, so what if you were flipping that coin and only 30% of the time did it go in your favor, but you gained 10% on average, and you lost, your average loss, your stop loss is set at 1% of your position. Well, then you'd still come out 23% ahead. Simple as that. You know, it really comes down to very simple math when you're talking about kind of managing your capital in these positions. Now, if your accuracy is 10% and your average gain is only 10%, you're only going to gain 1%. You know, is that worth your time and effort? Probably not. You should probably try to shoot for better, but as you're learning, you're not losing money. And that's a big step in trading, when you go from not losing money consistently to actually breaking even or making money. A lot of people spend years losing money. Now, of course, here we have accuracy of 30%, average gain 5%. You can see, boom, 20%, 10%, net 13%. Accuracy of 10% with the average gain of being 5%, you start to have a loss, 4% loss. So really your net performance is a function of your accuracy and your average gain percentage, which is why it's nice to be doing things like selling portions into strength at certain risk multiples and then moving your stop up, you know? So like, let's say I got here and I sold 10% of my position here, and then I moved my stop loss up to the low of like this prior week or whatever. Well, I guess this would be the prior week because it's the weekly chart. I'm so used to looking at dailies that sometimes I, lose track a little bit. But yeah, let's say you move your stop up to the low of this week. You take a third off here. Well, then 3, 4, 5. Do you take some off here? Maybe 6, 7, 8, and then you just keep trailing your stop up, so that as the position moves up, you're protecting your capital. That is truly the name of the game, is one, protecting your initial investment by limiting your loss to a fixed percentage or fixed amount based on your account size. And then two, protecting your gains. You know, you don't want the mental anguish of being up 20% or whatever in a certain stock, and then a couple days later you're only up 5%, and you're sitting there like, why did I not sell? Why? I could have gotten rid of this. Why didn't I sell? So you want to be taking stuff off because it saves the mental capital, you know. But yeah, I think that does an alright job at elaborating on kind of what I was talking about last time, because I did mention that it's a probability game, you know. So you want to scout these setups that have high probability, strong sector. Within that sector, find the leading names, the strong names that have the most volume, the most attention. Look for that higher lows, the higher lows starting to form, and then find a position anywhere. You could enter this thing anywhere from, if you're really lucky, in here. If you're being a bit more patient, in here. You could even enter in this week up here and got a solid risk to reward off of this. But that being said, and that is pretty much all I got for this one for now.